Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest and author of The Options Playbook. Today we're going to have a discussion on what happens to your option position inside your account after a stock goes through a stock split. We have two mega cap companies that are going to be splitting their stock soon, Amazon.com and Alphabet Incorporated. Both of these companies are going through a 20-for-1 stock split. So what does that mean? That means that if I have one share of these companies in my account after the 20-for-1 split, I will get an additional 19 shares for a total of 20 shares in my account. Now, the price of the underlying stock will also be adjusted. You'll take the price of the stock and divide that by 20, and you'll have a lower price of the stock for both of the companies. Now, the goal of a stock split is not to change the company fundamentally. What will happen as far as the market value of the position is concerned is that you will have the same valuation when it's all said and done. Now, when a stock split takes place, you're going to have a lot of different important dates that we need to make you aware of. The first one is the record date. You need to own the stock before the record date to participate in the split. Next, we have the split date. That's when all the bookkeeping is going to happen in both Amazon and Alphabet, and that usually is on a weekend. Usually the split date is a Friday, and that allows the back office people to do all the work behind the scenes. And then the effective date is when you get the additional shares. That's usually on the Monday. So you wake up on the Monday of the effective date and you see the additional shares in your account and the stock at a lower price. Now, in the options world, the math is very similar. So let's go through an example using the Amazon 20-for-1 split. So let's say in your account you have two Amazon June 17th expiration 2400 strike call options. Now, for each contract or each call option that you have in your account, you will receive an additional 19 contracts. To make the math simple, that means that you take the two as far as the contracts are concerned and multiply it by the split number, in this instance 20, and after the effective date you're going to have 40 contracts in your account. But there are other components inside an option contract. One of them is the strike price, so that has to be lowered. So we take the strike price of 2,400, divide that by 20, and your new strike price will be 120. And then we have to adjust the price of the actual option contract. In our instance, the price is $52.80, divide that by 20, and we come up with $2.64. Now, the price is going to be dependent on where the underlying stock is on the effective date, of course. But in our example, if we had a fixed price of $52.80, when we woke up on Monday after the effective date, we'll see that the price will be trading somewhere around $2.64. Well, I hope that clarifies what happens to your options once a stock splits. My name is Brian Overby. Please follow me on Twitter. My handle is @BrianOverby. And if you'd like to learn more about the educational events at Ally Invest, please go to ally.com/investeducation.